Ladies and gentlemen, please join me in welcoming Mr. Mohnish Pabrai. For those unfamiliar, Mohnish Pabrai is an esteemed investor, entrepreneur, and philanthropist. He's the founder and managing partner of Pabrai Investment Funds, a global investment firm known for its value-oriented investment approach. Mr. Pabrai is also a close friend of legendary investors like Warren Buffett and Charlie Munger, and he has authored several books, including The Dundo Investor and Mosaic Perspectives in Investing, which have become influential texts in the investment world. And beyond his investment acumen, Mr. Pabrai is a passionate philanthropist. He, along with his family, has established the Dakshana Foundation, which provides underprivileged students in India with access to world-class education, empowering them to realize their full potential. So please join me in giving Mr. Pabrai a warm welcome. We'll start off with an opening address by Mr. Pabrai, and we'll follow up with questions thereafter.
All right. Well, it's a pleasure to be with all of you. Thanks for having me. And hopefully the time difference works out reasonably well. It's not an ungodly hour on your end. So I just have kind of one thought I wanted to share with you guys, and then probably more interested in what you guys want to talk about. And in the first Gladiator movie, there's an old king who makes an appearance right at the beginning of the movie very briefly. And that's Marcus Aurelius. And his name comes up a few times in Gladiator 2. But Marcus Aurelius had a very difficult life. He spent almost his entire life on the battlefield. Lots of injuries, lots of illnesses, lots of adversities. And he came up with a philosophy known as the Stoic philosophy, and which is now the book he wrote called Meditations, which goes over that philosophy. But the essence of what I've gotten out of it is, like there's a quote by him that to encounter misfortune and overcome it is good fortune. So basically what Marcus Aurelius is saying is that anytime we run into adversity in life, we need to kind of, man up and, deal with it. And the reward of basically dealing with it is that subsequently that particular adversity is going to be the kernel that leads to greater height or greater growth, etc. And what I have found in my life, and I think, Charlie Munger talks about it as well, that basically no matter who you are going to have a lot of reverses in life, a lot of adversity, a lot of misfortune that shows up in unexpected ways. And so it's not like some people are immune to it. I mean, the case of Charlie, he lost his son to leukemia when the child was 11 years old. It was very traumatic for him. There was a botched cataract operation where he lost one eye when he was probably around 60 years old. And then he actually subsequently had issues with the second eye as well, where there was a good chance he would go blind in that as well, blind in both eyes. And Charlie's perspective was you always just soldier on, These things are just going to keep happening, just keep moving. And when I look back on my own life and I look at the big setbacks that came at different points, and I look back on what the impact of those setbacks was, I cannot point to a single one that did not lead to greater growth and better outcomes in the future. So we cannot see it at the time it's happening. We also don't know how exactly this misfortune is going to turn into a good fortune. But my viewpoint now is that basically just have blind faith in it. So basically, if I hit some adversity, I actually now I'm pretty laid back about it in the sense that I say, okay, I don't know how this is going to be helpful, but I know it's going to be helpful. And so I just kind of go with that. And so far, there has not been a single case where that has not been the case for me. And in an investing context, this happened at least 2 times. There were 2 major incidents that took place in my investing career, which were major reverses. The first was just before I had started Pabrai Funds in kind of the 1998, 1999 timeframe, where the dot-com boom was up in a big way. The bust of 2000 had not yet come, and there was just a big frenzy going on. And I got carried away in that frenzy as well. And I had invested about $4.5 million in a dot-com startup that would eventually go to zero. Out of the $4.5 million, about $2 million was my own money, and about $2.5 million was from venture capitalists and other investors and so on. And it was just terrible. I mean, to go through that, lay off everyone. And I look back, we just made so many mistakes. But what happened with that experience was that when later was switching to starting Pabrai funds and was going to invest in the public markets, Pabrai fund started in July 99. So we were still about 9 months away from the crash. But because of my experience with the dot com, I was maybe just about 6 to 9 months ahead of the public markets in terms of knowing that this was a bubble and it was a big bubble and it was not going to end well. And so when Pabrai Fund started in mid 99, I basically did not, I mean, my background until then was all tech. And I basically invested in almost no tech. At the same time, all these techs and dot coms are becoming very valuable or very overpriced, basic brick and mortar stocks in the economy were becoming very cheap. So if you were willing to look in a more boring, benign part of the market, there were great opportunities there. And so that's kind of what Pabrai funds did. And my view at that time was that the major indices, the Nasdaq, the S&P, and Dow, etc., were not going to do well for a while, and in fact, they could go down a lot. And so, almost the entire portfolio was anomalies, special situations and things. And basically, I would say Pabrai funds in the first 8 years from 99 to 2007, we had no down years. We had around mid 30s annualized returns before fees and probably high 20s annualized returns after fees. And the Nasdaq had crashed and burned and the S&P was down and the Dow was down. So while we had climbed and done very well, all these indices, everything had gone down. So I was by 2007, I was managing 600 odd million, and we had made hundreds of millions in that approach. So if I looked at the 4.5 million loss and the hundreds of millions of gain, it was very clear that adversity at that time, which was very painful, actually had a silver lining and kind of helped out and went from there. And then this happened again in the financial crisis from 2007 to 2009. Pabrai funds went down like 2/3. I mean, the markets were down about 40% because we were concentrated, etc. And some just dumb mistakes, we were down 65, 67%. And again, basically, that adversity led to a lot of rethink and some very great investments, which I wouldn't have made if hadn't happened. And again, helped me grow as an investor. And we did very well after 2009 as well. So, given the station in life and the position in life you're in right now, where you have, maybe 8 decades or something ahead of you. I think it's a very good model, basically, to just have this hack in your mind that whatever bad things show up or bad things happen are going to lead to good things. And just like what Charlie says, just soldier on, and those good outcomes will eventually reveal themselves. So, with that, maybe I can, open up to questions and see what you guys want to talk about.
Yeah, that sounds good. We actually have some prepared questions. And I think it's really apt, given that you talked about your initial experience about loss having a silver lining. And I think it's really apt given the stock market environment we are in, with DeepSeek AI actually causing a serious stock market correction. We were just wondering about your perspective on it. Do you think it's an overdue correction, or do you think it's actually an opportunity to invest into the market?
I didn't get the full question. Are you talking about the current situation?
Yeah, the current situation.
The current situation, I find, I mean, I think that where markets are at and what markets are likely to do usually is a fool's errand. It's kind of not usually worth thinking too much about that. We get to some points in time in markets where it can get obvious, at least to some people. So for me, it was obvious in 99 that this was going to end badly. I think that was pretty obvious to me at that time. But for example, in 2007, I was clueless about the crash that was imminent and, pretty much just caught blindsided like a lot of other people. And I think my current view on the market is that if I look at something like the S&P 500, I would say that probably for the next decade, maybe 10 to 15 years, I don't think the S&P will do more than 3 to 5% a year over that period. And now, whether it goes down a lot and then kind of, has robust returns after that, or whether it flatlines, kind of how that plays out, I have no idea. And I'm not even sure whether my hypothesis of 3 to 5% is going to end up being accurate or inaccurate or where that ends up. I'm not particularly making bets based on that. So the bets I'm making for the most part, I mean, so for example, I have no tech. I have nothing related to AI, for example. And they're very basic bets there. I think they should not be correlated much with the market anyway. So whether the market goes up or down or flat, I think that these businesses eventually will do as well or poorly in terms of returns as the underlying business does. And so I think these are undervalued bets and they're good bets. And I'm sure some of them will prove to be incorrect. But I think as a basket, hopefully we'll be in the right place. So that's kind of how and I think like for most investors, and especially for all of you, I think it's not worth trying to figure out the market. It's too complicated to try and do that. It's too many variables.
Right, that makes a lot of sense. Another question that we had is that traditional value investors have had a difficult period over recent years, as large tech names have contributed most to the market performance, and legends in value investing have suffered from prolonged periods of underperformance. Given that context, do you think that value investing styles should rotate, or do you think value investors need to adapt to a new reality?
It is a mistake to classify investments as value or growth or things along those lines. So all intelligent investing is value investing, and it's every investment you make, the intrinsic value of that investment is the sum of all the future cash that business is going to produce between now and judgment day, discounted back to current dollars at some reasonable interest rate. And so it doesn't matter whether we are talking about Nvidia or we're talking about some oil company or whether we're talking about Berkshire Hathaway. If you have a way to figure out the cash flows of all those three different types of businesses from now to judgment day and then discount it back, it would become obvious which is the best investment. So it's possible Nvidia could be a great value investment. It's also possible it could be ridiculously overvalued. It's all a matter of what those future cash flow streams look like. And so, I mean, I think I would say what we have seen in the last few years, to me at least, it seems to indicate that there is plenty of euphoria amongst the large tech names, the Magnificent Seven and so on. And my view on those tech names is that the next maybe decade or so may not be such a great place to invest in them. But I could be wrong on that. And whether they are a great place to invest or not depends on the cash flow streams that come out of those businesses. So that's where the rubber meets the road. These are very dominant franchises, extremely good management teams, huge addressable markets. So they've got a lot of tailwinds. But at the same time, you're not investing in them at 3 times earnings. So to me, they fall into the too hard pile because I'm not able to estimate the future cash flows of those businesses. I don't know what Nvidia will produce in cash in 2030, for example. And that would be a pretty critical number. Try to figure out whether it's worth investing in Nvidia or not. So basically, the way I approach the problem is I limit myself to businesses where either I can clearly see what the future cash flows are and discount those back, or they fall into a category where it doesn't matter. And mostly, most of my investments fall into the latter category, that it doesn't matter. What I mean by that is that I made an investment about 6 years ago in a company in Turkey. I've talked about this a few times, but a company in Turkey which has a few different businesses, but their main business is leasing out warehouses. Very simple business. They're the largest kind of renter of warehouses, landlord of warehouses in Turkey, approximately 11 or 12 million square foot footprint. And at the time I had invested, the day I first met them, the market cap was 16 million, 16 million US dollars. And I was told the liquidation value was like 600 to 800 million. It was relatively easy to calculate the liquidation value because there were like a bunch of warehouses. You could pretty much go to any realtor, any commercial realtor in Istanbul, and probably would not take them that much time to give you kind of valuations on those properties. And there was about 200 million of debt. So the properties were probably had a value of about a billion, 800 million to a billion. And you take the debt out, you're like left with 600 to 800 million of equity value. And your market cap is 16 million. So future cash flow streams of that business, first of all, were very predictable because they're renting warehouses and they got leases. And so one could get some view on that. But one didn't even need to get a view on that because we were less than 3% of liquidation value. And then I thought that we may not be able to get much stock because this might be illiquid, etc. But Turkey is a market filled with gamblers. The average stock at that time, and maybe even true today, cycled through its entire float in less than 20 days. So huge trading volumes, which means that everyone was a renter of the stock. There were no real owners. For about $8 million or so, we were able to get 1/3 of the company, which actually stunned me. And at that time, and even today, there was a mass exodus of foreign investors leaving Turkey because the currency was so unstable and inflation was so high. My view on that was that, this is prime land in Istanbul. A warehouse is land and cement and concrete and steel. All of those factors are inflation indexed. So it doesn't really matter what the currency is. Those warehouses have a value. They have a kind of a global value. So we invested, and basically now that business has a market cap of over a billion US dollars. The Turkish lira has been decimated, but it didn't really matter to us because I was looking at everything in dollars. And I mean, the stock has gone up, 40, 50x or whatever. And it's still undervalued because now the liquidation value is north of 2 billion. That's an example where we didn't really need to invest, really kind of figure out the cash flows. But that business would have been relatively simple to figure out the cash flows. It wouldn't have been that hard. I didn't bother to do it because I just said, okay, discount to NAV is so high that the other metric is not relevant. What we want to do as investors is we want to reject all investments unless they fall into a category where nothing makes sense. So when you run into investments when nothing makes sense, like I would say that our Reysas investment, when we were making it, it made no sense at all. Why would something like that trade like that? Why would the insiders not buy in the stock? There were a lot of questions we didn't really understand. But when things don't make sense at all and the dynamics are such that they are likely to work out in your favor, that's when you need to go all in because that won't happen very often. So I think the experience for value investors, let's say in the last 10 years, may not be that great if they were focused on kind of, non-tech traditional value, if you will. But as long as those cash flow streams are there and all of that is there, I mean, markets historically have easily gone to 10, 20, 30 years of doing nothing or certain asset classes doing nothing. So that's pretty much par for the course. So we really cannot make any assessments of some asset class or whatever based on 5 or 10 years of data. So that's how I look at it.
Right, that makes sense. And I think it's a prime example of a thing that you have, which is heads I win, tails I don't lose much. I was just wondering, on the contrary, have you ever encountered an investment where this principle has failed you and what went wrong in the instance?
Well, we have a lot of investments that don't work out in spite of our best intentions and in spite of being careful before we invest. And so John Templeton used to say that the very best investment analyst is going to be wrong 1 out of 3 times. And most of us are going to be wrong at least half the time. So if I go back and look at everything that didn't work, it's a very long list. Of course, there is an asymmetry. And the asymmetry is extremely lopsided in venture investing, where when you lose money, you lose 1x of what you invested. But when you win, you might win 10,000x of what you invested, or 100x or 1000x. So, in that dynamic of venture investing, what is important is not so much avoiding the losers as it is to make sure that the winners are in your portfolio. I mean, I think that's a very difficult game. I think for me, especially, I think that venture investing will be a very difficult game. But there are some firms and some individuals who are exceptional at that game and who do really well at it. I mean, to give you an example, I was watching a video recently with Bill Gurley, who's a very successful venture capitalist at Benchmark Capital. And, they're very focused on trying to get these 10,000 X's or 1,000 X's in their portfolio. And they've got a lot of acumen, which allows them to see that. But he said that when the Google guys came to see them, and at that time, I think Google had less than 20 people on their team, they turned down the investment. They could see many good things about it, but they also had a lot of red flags that were coming up with the Google nuances. You had two PhD computer science students, computer science grad students who both wanted to be CEO. They weren't interested in bringing in an outside CEO. They were hardcore nerds. They were going to a space where there were a lot of players already, Yahoo and Alta Vista and all that, and on and on. And so they said that it wasn't like it was close for them. He said it was pretty much a no-brainer for our partnership. We all looked at each other and said, okay, this is an easy pass. And then he said that Sequoia and John Doerr both invested in Google at that time. The pitch that Sequoia and John Doerr heard was the same pitch that Benchmark heard. And Bill Gurley says that they were able to somehow sift through all that data in a little bit different way than they did. And they ended up with Google in their portfolio and they made the 10,000x and such. So when we look at some venture capital firms, like especially, let's say, Sequoia Capital, for example, they've shown an ability to kind of repeatedly be able to do this, decade after decade. It's quite stunning, actually. They've got some DNA, magic DNA, which allows them to do that. And I think for us in the public markets, value investing world, we're not going to get 10,000 baggers. And 100% losses are very expensive. So the focus has to be very heavily on trying to minimize the downside, because we know we're not going to get massive, we may once in a while get something which ends up being a 10x or 20x or something, but most of the time it's going to be a game of singles. And so when I look at Pabrai funds, we made a lot of mistakes during the financial crisis, 2007. Going into the financial crisis, I had significant exposure to levered financial institutions. I mean, kind of the worst place to be at that time. And we had a couple of zeros. We took a straight 100% loss on a couple of investments at that time. And there's been plenty of losers along the way. But, like Charlie used to say to me, that you want to learn from your mistakes, but you don't want to learn too much. So you have to look at your mistakes, you have to study what happened, and then you have to move on. So it's not like we're going to get to a situation where, I mean, when I look at my portfolio today, I could not point to a particular stock that I think will not work. But I know that as a basket, some of them will not work. And in due course, I'll figure out, it'll become obvious which ones, but it's not obvious today. And so that's the nature of it. And that's why we need a basket. And we kind of take it from there.
On that note, we'll be opening up questions to the audience. If there's anyone who has a question, please raise your hand and we'll bring the mic to you.
Thank you for taking the time to speak to us today. My question is, what do you think the most overlooked principle or skill is when it comes to investing? What do you think people aren't doing enough of now?
Well, the number one skill to be a good investor is patience, and extreme patience. So if you are the kind of person who loves to watch paint dry, then the investing business is for you. And especially in public market investing, things can take many years to play out. Even our Reysas investing, which was so extremely undervalued, did nothing for a couple of years. I mean, to have that type of distortion in the market last for all these years is really quite remarkable. But that's the nature of investments, is that we are going to see our patience tested. And so patience is very important. I think the second thing that's really important is that you should be able to have the thesis of your investment in 3 or 4 sentences. Why is this investment going to work? What are the drivers? And it should be something that you should be able to explain to a 10 or 12-year-old without losing them and without losing their attention span. So it's very important to be very patient, and it's very important to have extreme simplicity. So investment ideas can be complicated, but once you've done the work, that complexity should be gone and replaced with something relatively simple. And, it kind of becomes easy that way. Sometimes I get asked, like, okay, so our investment in Turkey, Reysas, which is now a very large portion of the portfolio, how did you have the conviction? Well, it's the easiest stock to have conviction in because my reference point is what's the liquidation value? I mean, the intrinsic value is higher than that, but we haven't even gotten to liquidation value. So when we get to a full liquidation value, then we can look at what is the intrinsic value. So it's easy to hold the stock if it's below liquidation value. And so the only thing I need to really do in terms of the business is have an understanding of what liquidation value is. And that's it. And so the thesis is very simple. And conviction to hold it is also very simple because everything is obvious. So if you don't have extreme clarity and extreme simplicity in your thesis, then when the stock drops 50%, which a lot of stocks will drop 50% after you buy them, you would not have the patience then to hold it because you would start second guessing all kinds of things. But if you have a hard coded, thesis in your head, which you think is high probability, and if that thesis is intact after the drop, the conviction stays intact as well. So I think those are the important things, is to extreme patience coupled with extreme simplicity.
I have a question regarding your fund's investment thesis and how it sort of evolved over time. Do you sort of have this conviction of certain assets you invest in, and does that stay with you for the entire time of your fund, or do you sort of really sort of dynamic over time and sort of decide to change some of your theses?
My mandate gives me a lot of flexibility. I mean, the funds don't lever themselves. They don't go into options or derivatives. We don't short anything. So outside of that, in terms of long only, mostly equities or all equities, it's a pretty wide mandate. And within that mandate, there is no strategy. It's opportunistic. So we look at, what makes the most sense. What are areas of the market that are hated and unloved, for example? Generally speaking, like Charlie used to say, you should go fishing where the fish are. And so don't go fishing where all the fishermen are. Go fishing where there are no fishermen and a lot of fish. And that would be another reason to not spend too much time on the Magnificent Seven, because there's a lot of fishermen there. So generally speaking, you want to be where there's a lot of opportunity and no one's interested. And that was the situation, and that probably still is the situation in Turkey. So that's why I've been making trips every year to Turkey, and we are very happy with the exposure we have there, because again, it was irrational because of the extreme fear and hatred that was still happening there. Warren Buffett, I like to say, has a Swiss Army knife approach to investing. So even though Charlie Munger worked on him for several decades to basically buy the great businesses and even pay up for the great businesses, which Berkshire does do, and it's like the bulk of what they do, Warren still enjoys his weird special situations and workouts and all of that. So, for example, when he made the bet of the 5 Japanese trading companies, and the way he made that bet, where he borrowed the entire amount in yen, non-recourse, and the interest rate on that was 0.5% a year, and these stocks had a 8% dividend yield. So pretty much without putting up equity, he was basically, significantly cash flow positive after interest payments and so on. And in fact, then after that, they doubled their dividends. So in fact, the yield on his original investment, went to 15%, just dividends, And then, of course, the stock prices doubled as well. So it was a huge home run. But it's because of his kind of Swiss Army knife approach that he's able to look at a lot of things and slice and dice them a different way. So I think as an investor, being flexible, reading a lot, looking at what's happening. And at some point, some things may show up on the radar where you're saying, okay, this looks truly exceptional. There's no fishermen here. There seem to be a lot of fish here, and it looks like a good bet. And so then you can, go for it. So that's the approach. There's no strategy as such.
So I have a question more on your portfolio and how. So I understand that you mentioned that for individual stocks you look at like the competitive mode and the business itself, but across your whole portfolio, how do you balance across all your investments? And I guess how do you manage risk across all your investments, considering that in very big multi-manager hedge funds now that drawdown is looked at quite closely for each like portfolio. So how do you manage across all your investments in a sense?
Yeah, that's a great question. And it's actually a dilemma we have faced recently in sort of an extreme way. So going back to our beloved Turkish REIT, we own a third of the business, but 20% of that business is in one fund. It's our offshore fund, which has about 400 odd million in assets. And so if we look at the 20% of, something north of $1 billion, more than half of that portfolio is a single Turkish stock. And we have another stock in Turkey, which has also gone up and also become sizable. I think that's like 17 or 18% of the portfolio. They're both very undervalued. So it doesn't really make sense to trim those. So we are talking about like kind of more than 2/3 of the portfolio in two businesses in Turkey. Then we have in the same fund a couple of bets in the coal business, which are around 15-20% of assets. So by the time you look at the two Turkish businesses and the two coal businesses, we are already at about 90+% of the portfolio. And most of my investors, individual high net worth families, we don't have really institutions and such. So what I told my investors is, I said, look, if you have an investment in this fund and the total amount you have invested in the fund is less than 1/5 of your total net worth, then if I were you, I would just do nothing, just let it be. Because what that would mean is that on a look-through basis, no single investment in the fund is more than 10% of their net worth, which is pretty reasonable concentration. And I said that if it's more than 1/5, then you should trim. My recommendation would be that you should withdraw some of your holdings from that fund to bring it within that sort of a limit and invest it in something non-correlated. So I told them that I wasn't going to kind of adjust the portfolio. They needed to adjust on their end, knowing what concentrations we have. And we saw some investors act on that, which is good. And such, they've kind of, adjusted things to kind of bring it within what they feel comfortable with. And so we spend a lot of time now giving a lot of data and transparency to our investors on the degree of concentration and how they can, mitigate some of it. And so, it doesn't make sense for us to trim something that is sitting at less than half of liquidation value. That just doesn't make much sense to do, especially because good investment ideas are very rare and hard to find. And I take the example of the Walton family, Sam Walton. So Sam Walton, when Walmart had its IPO in 1970 or thereabouts, his family owned about 36% of Walmart at that time. And he had already well before the IPO, he had already transferred the shares to his kids. So basically when Sam Walton passed away, the shares were already in the hands of the next generation and they didn't have any taxes or anything to pay. It just passed on to the next generation, which is very efficient from an estate planning perspective. If we look at entire Walton family stake in Walmart today, it is actually higher than it was at the time of the IPO. The entire Walton family stake today is in the kind of low 40% range. So they've actually gone from kind of mid 30s to low 40s, right? And what that means is that probably the overwhelming portion of the net worth of that family is in a single stock. It's in a stock where Sam Walton hasn't been around running that place for more than 30 years. And there are no family members in senior positions at Walmart. and there's maybe just one or two of them on the board. So they don't have control from a board perspective. And basically, they're extremely concentrated. And so I told my investors that we are not founder or part of the management or on the board of the large position we have in Turkey of Reysas, but I think of it as a family business. I think of it like Walmart. I think it's a very good business because I've watched it for 5 or 6 years. I think it's run by exceptional capital allocators, very good assets, very good capital allocation, and don't really see anything going on there that gives me a pause to do something else. And so the way to build wealth is to concentrate. All the billionaires you see around you only got there because they were concentrated. And like Munger used to say, there's very few times in your life that you're going to get a trip to the pie counter. And when you get a trip to the pie counter, you need to load up big time on the pie. You don't need to just take one bite of the pie. You need to load up because it's not going to happen that many times. I don't expect to ever find another stock at 3% of liquidation value in my lifetime. So that's the way it is. That's how we think about portfolio concentration, all that. We don't have any hedges or anything. We're not going to trim positions just because they get too large. Just like the Walton family has not trimmed because Walmart got too large. They've actually bought more stock since the IPO.
Thank you for your time today. My question is relating to your book, The Under Investor.
In light of changes in like the financial landscape, and given that The Under Investor was written quite a while ago, do you have any additional insights or different opinions that on that you have written in the book if it was written today?
Yeah, I mean, I think what happens, one of the good things about investing is that all knowledge is cumulative. So unlike, for example, if I was a basketball player, for example, I would probably peak maybe early 30s at the most or something, and then would decline after that. In the investing business, like Charlie used to say, Warren is still getting better in his 90s. So this is a wonderful pursuit because as long as this much of your body functions, you can keep getting better. You just need, the top kind of 9 or 12 inches of your body to function well. And then the rest is fine. And then the top 9 or 12 inches can function well for your whole life, hopefully. And what happens over time is that you obviously see things and learn things, and you learn a lot from the mistakes. The winners don't teach you much, but the mistakes teach you a lot. And over time, you pattern recognition and things, and you tend to get better. So yes, if I were to do a second edition of the Under Investor, there would be 2 or 3 changes I would make to it. One of the changes I would make is that true wealth is going to come from a long-term buy and hold of exceptional businesses bought at reasonable prices, held for a long time. So that has to always be kind of the number one goal, is our hunt for these great gems. Now we can couple that with other things like Warren's Swiss Army knife and different things, but the core has to be, that's kind of like the anchor. The anchor of the portfolio has to be great businesses run by great people with good capital allocators and just, great economics and, hold them for a long time. So I think that's something I would emphasize a lot. You have a gifted investor in the UK who hung up his boots, but is beating everyone after hanging up his boots, which is Nick Sleep. And it's difficult to get Nick Sleep to come out and talk to people, but maybe you can nudge him and see if he's interested. And, when Nick shut down his fund, he basically put all his money into 3 stocks, 1/3 each, 1/3 into Amazon, 1/3 into Costco, and 1/3 into Berkshire. And I think his fund shut down in 2012 or 2014, thereabouts. And I think he's trounced the S&P and everything else since then, doing nothing. No work involved in the portfolio. At one point, he got concerned because Amazon went up so much that it became, kind of 60% of the pie. And he cut the Amazon position in half and bought what I consider to be a terrible business as a 4th position. And that 4th position didn't do well. And he would have been better off just, sticking to the ones he had actually originally selected. Even with that mistake, he's still done very well. So it's a very forgiving business from that point of view. So that's what I would change the focus of the book to basically say that the real thrust of the effort needs to be to get to an ownership position of great businesses that you can hold for a long time. So we don't need to be founders of Walmart. We don't need to be founders of Amazon to do well like Mr. Bezos or Sam Walton. It was possible to ride their coattails, even having 100 shares or 1,000 shares. And so that's the beauty of the equity markets, is that you can have, in fact, the smaller investor has a big advantage because they can go anywhere and do anything, which is a huge advantage. Size becomes a big negative. And so that's what those are the changes I would make, is a big emphasis on buy on hold and couple that with a Swiss Army knife for other things that look interesting.
With that, we have come to the end of the fireside chat with Mohnish Pabrai. Once again, we would like to thank Mohnish for his time and insights on investing and life in general. Let's give a huge round of applause for Mohnish again.
Well, thank you so much. It was a real pleasure, and I wish you all the best. Bye.